Hello and welcome to class. Today is the second day of our free online Forex training seminar. And on behalf of ROS-RENA Forex Training Institute, I welcome each and every one of us to the class. In our last class, we talked about what is Forex. We did our best to define what is Forex. And I really do believe that each and every one of us understood very well the concept of Forex and Forex trading. If there is any question, I believe we will ask as we continue. But for today, we'll be moving over to the next topic, which is Forex terminologies. And the first terminology we are going to be talking about is candlestick. Candlesticks are a form of chart analysis used to identify potential trading positions. They represent the size of price moves. With the aid of the candlesticks, traders are able to make informed decisions on the position to open. Generally speaking, the longer the candlestick, the intense the buying and selling pressure. Short candlesticks indicate little price movement and represent short candlesticks indicate little price movements and represents the position or the extent to which price the price is determined in the market. Now, what do we mean by that? Like if you recall, in our last class, I told you that when you go to the chart, the trading order which is on the trading platform, you are not going to see money on the platform or currencies written on the platform, because I remember defining Forex as the buying and selling of different currencies. Now, like I said, when you go on the platform, on the trading platform, which is the chart, you are not going to see these different currencies shown there, but rather what you are going to see is representations, chart analysis, which in Forex is known as candlesticks. Like as you can see, these two diagrams that are on the note, they are the candlesticks we are talking about. Let me take you to the chart. You can see the chart here now. This is what the chart looks like. You can see these are candlesticks. For me, you can use any color to represent yours, but for me, I prefer using the green and red. Now, there are two different types of candlesticks. As you can see here, or even as you can see on the chart here, one is green and the other one is red. By the time you get to this stage, you can decide to use a black and white or purple and yellow to represent your own. So like I said, there are two major types of candlesticks. In fact, there are two types of candlesticks. One of them is the bullish candle and the other one is the bearish candle. I said one of them is the bullish candle and the other one is the bearish candle. The bullish candle represents the upward movements, while the bearish candle represents the downward movement. I come again, the bullish candle represents the upward movement, while the bearish candle is for the downward movement. This one you are seeing here now, you can see the green candlesticks are formed when there is an upward movement, while the red candlesticks are formed when there is a downward movement. Therefore, the green candlesticks are bullish, while the red candlesticks are bearish. So those are the two different types of candlesticks that we are going to be seeing. Okay, I wrote it here. You see the bulls. A bullish candlestick is an indicator which shows pictorially an upward movement of the market activities. It informs traders that the market is having an uptrend after a previous downtrend or a decrease in price, while the bears are candlesticks that indicates pictorially that there is a downward movement. It informs traders that the market is having a downtrend after a previous uptrend. As you can see, the first one here is the bulls with an arrow indicating upward, while the second one is the bears with an arrow indicating downwards. The next concept we are going to be talking about is range or consolidation. In ordinary terms, range refers to the area of variation between upper and lower limits or on a particular scale. A range-bound market in Forex is one in which price bounces between a specific high price and a low price. The both prices act as major resistance limits where it fluctuates, where the fluctuating price can't seem to break through. Well, here you just have to take it down. As we continue, I'm going to show you exactly what we are talking about. Now, what we talk of consolidation, but for emphasis, range and consolidation are always almost talking about the same thing. That is a situation where the price fluctuates between a particular upper price and a particular lower price. The price does not go beyond that area. But I think by the time we go into the trading platform, I will be able to show you exactly what we are talking about. Now, consolidation, on the other hand, is a period of range bound activity after an extended price movement. It usually occurs after a downtrend or uptrend and can be seen as a stretch of indicators. A stretch of indecisions. It is usually caused by professional traders taking profits. So, in effect, what this really means is that during a range, it talks about when price fluctuates between a given positions, between a a given high position and a low position, or a given buy position and a sell position, defined within an area of resistance and support. It does not go beyond that particular place. Now, when it lasts, the period with which it lasts is the period of consolidation. The period within which this activity or these movements last within a defined place is what is known as consolidation. Now, we also need to know long and short. These are also terminologies used in Forex, which refers to a buying or selling position. When a Forex trader says take a long, he's referring to taking a buy position. When it says take a short, it refers to a sell position. Now, the next terminology, we also have terminologies like position, which is a position is a place where you either take a buy or open a buy or a sell option. That is what position is all about. We also have a terminology known as a downtrend and uptrend. The uptrend simply refers to a time when the market is moving upwards. And in such cases, in Forex, you take a buy position. Now, when the trend comes down, which is the downtrend, is when you take a sell position. Then we're going to be talking about currency pairs. Currency pairs, which refers to the quotation of two different currencies with the value of one currency quoted against the other currency. Now, I take you back once again to our first class, where we talked about when I mentioned to you that all what happens in Forex is the buying and selling of different currencies. And in the course of buying and selling of different currencies, it is assumed that you have one currency or you have one currency and you are selling that your currency in place of the other one. So you will always see currencies quoted in pairs. And that is what the kind of example you are seeing here. You can see this example. Here you have euros against the US dollar. So here, the US dollar is the quote currency, while the euros is the base currency. You either see it in this way, in this form, or you see it in this form. You see it in this form. So one of them is the base currency, while the other one is the axe currency, quote currency. Or on the other one, on the other way around, you say one of them is the bid currency, while the other one is the ask currency. So that is it. You can see the price traders buy at the forex market, while the bid currency is the price traders sell at the forex market. So those are the terminologies that we are going to be talking about, which we have explained to you at this moment. Now, I've brought you to a an example of the chart. Now you can see here the representation shown here. The candles that have that the body is empty is the bearish candles, while the bullish candles, while the one that the body is filled is the bullish candles. So you can see the bullish and the bearish candles. Then here within this place where you see uh, a rectangle covering the chart, within this area is a range. Within it is a range, while the position covered by the upper horizontal line and the lower horizontal line is what we defined earlier as uh, the consolidation. It consolidates here. The price consolidates here. The price consolidates between the upper horizontal line and the lower horizontal line. With this, we come to the end of this class. I'm looking forward to meet you in the next class. Thank you.